It's January 2026. The stock market is defying gravity, breaking records almost daily, and we all know why. It's two letters. AI. Just last week, NVIDIA CEO Jensen Huang dropped yet another bombshell, announcing next-generation chips that are 5 times more powerful than what we had just a year ago. The market went wild again. But amidst the champagne popping on Wall Street, there is a growing, nagging fear. You see it in the comment sections. You hear it in whispered tones among veteran traders. It feels too easy. It feels too fast. It feels exactly like 1999, right before the dot-com crash wiped out trillions of dollars. So, the trillion-dollar question, the one that determines your financial future over the next decade, is this. Are we witnessing the dawn of a new industrial revolution that justifies these insane valuations? Or are we standing inside the biggest financial bubble in human history, waiting for the pop? Today, we are dissecting the math, the hype, and the terrifying reality of the 2026 AI market. Let's start with the bulls, the people who say, forget the bubble, buy the dip. Their argument is strong because it's based on utility. Unlike the crypto craze of a few years ago, which was mostly speculation, or the dot-com era where companies had zero revenue, AI is actually doing things right now. The bull case is that AI is not a product, it's utility, like electricity. It is fundamentally lowering the cost of intelligence. Corporations across Europe and the US aren't just buying chips for hype. They are seeing massive efficiency gains. They are automating complex tasks, slashing payroll costs and customer service, and accelerating R&D. When a company uses AI to increase its profit margins by 20%, that company becomes objectively more valuable. That justifies a higher stock price. Furthermore, look at the demand. The hyperscalers, the Metas, Googles, and Microsofts of the world are locked in an existential arms race. They cannot stop spending. If they stop buying the newest chips, they fall behind, and their core businesses die. This guarantees a floor under the revenues of the chip makers for at least the next 2 to 3 years. The bulls argue that we aren't at the peak. We are barely at the foothills of a 10-year exponential climb. To them, these high prices aren't a bubble. They are the entry fee for the future. Now, let the bears enter the room. And their argument is terrifyingly simple. It's about math. The bears argue that while the technology is real, the valuations are fiction. We are currently pricing these AI companies as if nothing will ever go wrong again. When a stock trades at 80 times its earnings, it means investors are willing to wait 80 years to make their money back through current profits. That requires flawless execution forever. But history tells us that competition always arrives. Remember Cisco in 2000? It was the company that built the plumbing of the internet. It was a real company with real profits. It became the most valuable company on earth. Then the bubble popped, and it took 20 years for its stock price to recover. The bears say NVIDIA is the new Cisco, but the biggest red flag right now is the CapEx trap. These big tech companies are spending trillions of dollars building data centers and buying chips. That's capital expenditure, or CapEx. The problem? They haven't figured out how to make that money back yet. Sure, we use AI chatbots, but are consumers paying enough monthly subscriptions to cover $1 trillion in hardware? Absolutely not. We are currently in the field of dreams phase. If we build the massive supercomputers, the profitable use cases will come. The bears say, what if they don't arrive fast enough? Bubbles don't just slowly leak, they pop suddenly. And they usually pop because of something nobody was paying attention to. If the AI bubble bursts in 2026, what is the pin? Needle number 1, energy. We are running out of power. The new data centers required to run the models announced this year need gigawatts of electricity. We are talking about the power consumption of entire nations just to run chatbots. The grid in the US and Europe cannot handle it right now. If AI growth is physically capped by a lack of electricity, the exponential growth narrative dies instantly and the stocks crash. Needle number 2, geopolitics. We all know where the advanced chips are made: Taiwan. With current tensions incredibly high, any disruption, a blockade, an earthquake, a diplomatic standoff that stops the flow of silicon from Taiwan, brings the entire AI ecosystem to a screeching halt overnight. Needle number 3, the technology hits a wall. What if the next GPT model requires 10 times the compute power, but is only 10% smarter? If the rate of improvement slows down, the massive investment stops making sense. If the magic fades, the money leaves. So where does that leave us? The technology is undeniably revolutionary, comparable to the steam engine or the internet. But the financial mania surrounding it is undeniably reminiscent of past bubbles. If you sit on the sidelines completely, you risk missing out on the greatest wealth transfer of the century. But if you go all in on the hype, you risk losing half your portfolio in a single week when the mood shifts. The smartest strategy for 2026 isn't to guess the top. It's to diversify the play. Don't just look at the companies building the chips. Look at the companies using them. Look at the healthcare companies curing diseases with AI or the energy companies powering the data centers. These are the secondary plays that haven't hit bubble territory yet. We are in uncharted waters. The potential is infinite, but the risk is real. Watch your leverage. Keep some cash on the side for the inevitable corrections, and don't let FOMO drive your decisions. Thanks for watching.